How's it going, YouTube? Welcome back to another video with the House Money Investing channel. Today's video, we're going to go over some stock gains, a few stock picks of mine, and things of that nature. So jumping right into it here, I have some Tesla. I swung trade out of my Cash App a while back. I put in principal, pulled out my principal. My gains that I got from this swing trade were $14, so that $14 I left into the stock on Cash App. So this is all house money, free share, risk-free investment right here. So my $14 investment has now accumulated into $114.20. So a total gain of over $100. Well, technically $100.21. So this is kind of a prime example to show people with smaller accounts, or not much money to invest. I encourage people all the time, you can invest $1 a week or $10 a week, $5 a week. It don't have to be a lot of money. It don't have to be thousands of dollars or hundreds of dollars to get some gains. If you make several plays similar to this, then you will build your portfolio, and if they pay dividends, it's just going to compound over time. And if they're great long-term companies, this is just going to stack up over time. And if you keep investing, consistency is the key, and diversification is the key, in my opinion. So if you keep being consistent with it, and say if you put $14 on Tesla, this week, and then a few weeks later you put another 14 on it, kind of dollar cost average your way in, it's going to add up, because that growth stock's going to, it's going to add up over time, and you're going to see some gains, and you're going to, you're going to get results. We live in a microwave society, and people want instant results, but this is the play I made back in like March or June, somewhere around that time frame. So yeah, this is just to show you that small money can turn into a little bit more. And this is something I'll just leave in here forever. Unless something really bad happens with Tesla, then I'll sell it. But other than that, I'll just leave it there. And, just let it build up over time. Then we're going to go into some stock picks of mine. We got ticker SAM. This is Boston Beer. This is a nice play. I'm into like Coors. They have like Coors Light. I'm into Anheuser-Busch, which makes like Budweiser and stuff like that. So when I came across Boston Beer and I looked into the products that they make, it's actually some nice beverages. They do like alcohol beverages, adult beverages, and this thing here over the past year was up 160%. It was down 20% in the pandemic and still finished up at 160. And this thing typically grows on average about 70% a year. So it's actually a really good growth stock. The market cap is almost $12 billion, and it's still got some potential to run up back up to that 52-week high as well. It's roughly about $160 or $155 off the all-time high, so you still got a lot of potential there. Then I was looking at some analyst ratings, 50% buy, 36% hold, and Boston Beer competes exclusively at the high end of the malt beverages, which I see as a securely advantage related to the mainstream and value segments. The firm is one of two standout performers in hard seltzer, a category that has been growing its value by multiple factors. The acquisition of Dogfish Head should make its portfolio, a fast-growing brand with consistent and localized craft drinks. You know what I mean? And I was looking at the earnings. Quarter 2 and quarter 3 of 2020 were very well. They killed earnings, and this is a food and drink company out of Massachusetts. And they basically, like I said, do adult beverages, alcohol beverages. And I was looking at the brands, and they have like Samuel Adams, Twisted Tea, Angry Orchard, and things of that nature. And the one that really caught my eye, even though I know about Samuel Adams and Angry Orchard, what caught my eye was Twisted Tea. So, you know, Twisted Tea is a meme at the moment. You know, the guy smacked the other guy with the Twisted Tea for, you know, saying some stuff he shouldn't have been saying, right? And this can actually is going to help, you know, boost sales for this company. Same way with the other guy that went viral on TikTok when his car broke down. He skateboarded drinking ocean spray. That actually bumped their revenue because it's like a social media influence. There's a term for it, but I don't really know the term. But you can kind of get what I'm saying. You know, everybody's going to go out and buy some Twisted Tea and make, you know, TikTok videos, or people that's never heard of it, they're probably going to try it, or they might try it, especially, you know, these younger kids and stuff like that. So besides their fundamentals and their balance sheets already being good, that just kind of put a boost on it. And, you know, it raised my eyebrow, and I was like, okay, this is something I want to swing trade. It's something I want to get into. Moving on to the next one. This is ticker MSOS. This is a cannabis ETF. If you don't know, cannabis is being federally legalized. It's you know, spreading out across several states, legalized on the state level, and it's going to continue that way. Biden also has said some things similar to, like, you know, basically he's in support of it, and I will see why, because of the way the economy is beat down. You know, this is a lot of potential revenue, you know, for the United States if they legalize cannabis, you know, nationwide. That's going to bring in a lot of cash flow. This ETF is actually a fairly new ETF, started back in September, but it is up over 50%, you know, in 3 months. So this will give you exposure to the cannabis sector of the market, and with it being in an ETF, it's going to give you a great diversification and also keep that volatility down. So this is basically like a growth play, a growth ETF, and cannabis is just getting started. So I'm pretty sure this thing is going to explode. And you get a nice little payout of a dividend of 0.28%. So just a nice little payout. Looking at the PE ratio, this thing is still, you know, super undervalued. And like I said, it basically tracks U.S. stocks related to domestic cannabis and hemp industry companies. So definitely something to take a look at. I mean, you can own like Planet 13, you can own Royal Cannabis, Canopy Growth, Grow Generation, Sun Grow, just to name a few. But this ETF will probably have a little bit of everything in it. You know, from advisory shares, it's going to be, you know, straight U.S. cannabis companies, but the best of the best from, you know, advisory share standpoint. Next here we got KER. This is a regional banking fund. So the banking sector has been beaten down very badly, and this is going to be a bounce back play for 21 is the banking industry. The Feds announced the share buybacks. So you got like JB Morgan buying a lot of their share backs. So JB Morgan, Wells Fargo, Bank of America, those are a few banks that I see making a bounce back. And this is a nice fund here from Spider dealing with the S&P. So the best banks are all going to be in this fund. Now this particular fund was beaten down with the rest of the banks. Of course, it was down about 50% during the pandemic, and it still has about a 9% upside, you know, in growth for 2021, along with the nice dividend payout of nearly 3%. So you'll basically get about 11% return here. It's got a super low PE, so it's super undervalued, and that's because it's been beaten down. So this is going to be a bounce back play. So something to take a look at. Next here we got DFEB. This is also a nice little ETF. It's a equity deep buffer ETF for February. It IPO'd in February. Of course, it was beaten down right away due to the pandemic, about 15%. Still finished the year out, you know, up 5%. This is more of a growth ETF as well. and it aims for Pacific buffered losses and cap gains on SPY shares over a Pacific holding periods. And this is actively managed fund, and it holds options and collaterals. So you're gonna have the best of the best, doing options, collaterals, and that sort of thing in this fund. So it's not just like a set of something; it's gonna be actively managed, which is great. And it performed pretty well due to the circumstances. So I'm gonna go ahead and give this one a shot. Then we got ticker DBOC. This is a double stacker buffer ETF as well for October. So of course it IPO'd out in October. So in 2 months, it was about up 5 or 6%. And this is going to be a growth ETF as well. And it's still brand new, but it aims to cumulative cap gains on S&P and QQQ shares while providing a buffer on S&P losses over a Pacific holding period. And this is actively managed as well. So take a look at that one. It's fairly new, not much data on it, but from a fundamentals standpoint, I like it. And then we got PAAS. This is a play that I'm already in. I'm currently up 3.83%, and this is Pan Silver America. So this is going to give you exposure to the precious metal markets. I like to be in gold, platinum, silver, copper, those types of plays, just to get exposure to that sector. I like Pan America. I like their balance sheet. This thing was beaten down about nearly 50% during the pandemic. Still finished the year out above over 50%. And it typically gains about 90% a year is typical for this company. It's a very good growth company due to the fact that the price of silver is just steady going up, just like the price of gold, and it pretty much hit all-time highs this year, these metals. So like I said, I'm up almost nearly 4%, plus I'm collecting a nice little dividend of 0.64%. 10 analysts got it as an 80% buy. EPS has been a hit or miss, so hopefully projections on Q4 look like they're going to be great, and this is a Canadian company. It basically engages in the exploration, development, extraction, processing, refining, and reclamation of mineral properties. It operates silver mines located in Peru, Mexico, Argentina, and Bolivia, and they also do gold and other precious metals. I just recently got in this play, actually yesterday, so it is fairly new to me, and it is my first time swing trading this, and hopefully I have some success to increase my exposure in this sector of the industry. Next we got ticker PIC. This here is going to be a nice play as well. This is a iShares fund, which iShares is very great. And this is a global select metals and mining producers. So still in that same realm, with those type of precious metals. This one was beaten down about 40% during the pandemic. Still finished the year over 30%. And they typically have, about a 10% growth every year. 10 to 20%. 20% on the high side. So it's actually a great growth fund as well, due to the metals that it's into. Also pays a nice dividend of 2.27%. My sweet spot is 2 to 4%. So I love a 2.27% dividend yield for this company here. And it basically tracks global metal mining firms that are market cap weighted. So this is going to track the best of the mining firms. You got like mining firms like, for example, GDX, which is a gold mining play. You know what I mean? So it's going to track a little bit of all of them and different types of metals and things of that nature, all in one fund. And like I said, it's typically growing about 20% a year. So a great growth play with a 2 to 3% return as well. And you can let that dividend just kind of calm down and start a snowball effect and build up. This here is XME. This is another minings and metal ETF from Spider, dealing with the S&P. This one was also beaten down about 50% over the year. During the pandemic, finished the year up 16%. This one typically goes about 20-21% a year as well. As you can see, they all kind of have the same growth rate because they're all kind of dealing. They kind of overlap, but they're all a little different. You know what I mean? But they're all dealing with those precious metals. The dividend on this one is 0.99, so almost 1%. Super low PE ratio. I don't know how, but this thing is still, super undervalued. And it's going to track U.S. metals and mining companies. So the best U.S. and mining and metal companies in the U.S. are going to be in this Spider ETF right here. Then we got a SPAC, CIIC, or SIG merger. They're merging with a rival to the electric buses, which looks like city buses, but I'm sure they'll do like school buses and all Greyhound buses, probably tour buses, maybe RVs in the future. Who knows? Just my speculation. But yeah, it hasn't had the merger yet, so it's still a SPAC, but it's a play I'm into. I've been swing trading this thing heavy this month. In my Robinhood portfolio, I'm down like almost 7% on the position. So I need to go ahead and swing trade it again and see if I can get some positive results. That way I can average my price per share down. But once that merge happens, it should pop. This thing's been up 167%, since it IPO'd. Since the SPAC come out. The price to earnings ratio is super crazy, of course. And like I said, it's just a SPAC. I got in this particular play in my Robinhood around December the 14th. So yeah, I just added it back to the watch list. Something I'm going to swing trade again. I like the fundamentals of the company. Then we got GDXU. This is similar to the GDX I mentioned earlier in the video, but this is 3-time leveraged. So this is going to basically be the best gold miner companies in one ETF, but it's going to be a 3x leverage. So basically, when it goes up, whatever it regularly goes up, it's going to 3 times that. Same thing with a loss. So it is a little bit more risky, but you can see massive gains in this thing. This one just started back December the 4th. It's already up, 28% in a month. So at this rate, it's going up about 1% a day, which is crazy. Then we got PPL. This is also something I already own. This is something I'm going to continue to swing trade. This one here, if you look at the 5-year chart, it hasn't done great, but it has potential, and that potential's hit here lately. It was up 1% the past week. It is a dividend payer. I got a pending dividend, on the actually it was today, and I'm down 2% in the position, and I'm adding it back to the watch list because I'm going to swing trade it again. Does have a very good dividend yield, which they might really allocate that, but it's almost 6% dividend yield. Super undervalued, super oversold. PE ratio is at a 14. Analyst buy ratings from 14 analysts is a 36% buy, 64% hold. And PPL, they're selling their UK assets, so I think that'll give the company more focus on the US assets, which this is a utility company, right? I believe it's in Arizona, if I'm not mistaken. I expect earnings to grow, and they have a $13.8 billion planned capital expenditure supports, which is going to support the growth. EPS has also been hit or miss. I think quarter 4 EPS to do well. I've been buying this particular play back since September 4th, and like I said, it's a utility company, It engages in like generation, transmission, and the distribution of electricity. It operates in Kentucky, Pennsylvania, and also in the UK, but they're selling that division of the company. They also do natural gas out there in Louisville. So basically it's an electric company. So I mean, everybody needs electricity, so I'm sure those markets it's in, it's gonna figure out the balance sheet issues and get it right. I think this company is gonna have a nice turnaround this year. So I'm gonna go ahead and swing trade it again. Next, we got ticker ICLN. This is also something I already own. It's a iShares Global Clean Energy ETF. So the best clean energy companies in the world will be in one fund. It was beat down about 30% over the pandemic. Still finished the year up above 143%. It did exceptionally well this year. Typically, it only grows about 40% a year. But of course, clean energy is a big rave right now. And I'm down, almost a whole percent thus far. This is more of a growth play than a dividend play. It does pay a small dividend of 29% with a $5 billion market cap, decent PE ratio. This is a play I just got in, a couple days ago. But basically, it tracks the 30 of the most liquid companies involved in businesses related to clean energy. I think clean energy steady on the rise is going to steady pop. So of course that's going to be a play I want to steady swing trade. Then we got Carvana. If you don't know what Carvana is, basically it's a place where you can buy cars online. They'll deliver the car right to you. You got you can skip the whole deal with the dealership. Nowadays everything's e-commerce. They got these cool little like clear towers with the cars in there, like in a circle, and when you drive by it you can kind of see them through the windows or whatever. It's a dope concept. They also, I have a friend that has a 2020 Scat Pack, and he bought this car for $32 cash, and Carvana is willing to give him like 35 for it. And he's, it's got like 8,000 miles on it. So, they'll buy your car outright from you, as well as sell you one, and they actually give you a good rate on your car. So they're not, trying to rip you off or anything like that. So that's a great business model for them to build a loyal customer base. Now, Carvana was beat down 50% during the pandemic, of course. I mean, who was buying a car at that time? We were locked down. You couldn't even go nowhere. But it did finish the year out above over 150%. This is a new IPO, early May. In 1 year, this thing's up over 1,600%. I did not catch this play when it started out. I didn't jump in, but for the people that did, congratulations. That's massive returns, 1,600%. This is, it's a growth play. And 21 analysts got it 52% buy, 43% hold. Killed EPS in Q2, Q3. Looking at their balance sheet, they don't have too much long-term debt and things of that nature. Great fundamentals for this company. And like I said, it's an e-commerce platform. They engage in buying and selling used cars, and it gives you a different car buying experience. And it also has wholesale vehicle sales, which comprises of the proceeds from vehicles sold to wholesalers and things of that nature. So yeah, liking Carvana, I think it's going to steady grow. Their fundamentals and the way their business is structured is a very nice, unique play. So something I'm going to swing trade and get into. Then we got Flare, ticker FLIR. This is a nice play, and what they basically are into are like how do I say it? I want to say night vision, but it's not night vision. But they make cameras and cameras and sensors that are like night vision and stuff like that. It's slipping my mind what it's called, but basically these cameras can be used for like autonomous driving, basically, and they can see certain things that other sensors can't and other cameras can't. Oh yeah, it's infrared. That's what it is. So infrared cameras, so it can see people or animals in certain lighting situations and bad weather that your usual, like say my truck has a sensor on the front, right? And what that sensor does is, let's say if I have the cruise control on and somebody in front of me is going slower than what I'm going, my truck is automatically going to slow itself down. Or if I'm about to hit something, it's going to make a loud noise in my truck, on my dash, and it's going to automatically slam on its brakes. But when I drive this truck during bad weather, like a snowstorm, heavy rain, that type of stuff, the sensor gets blocked out and it doesn't work at all. So with these, what Flare Systems does is provide the infrared cameras, and these cameras are going to work through those type of situations. And autonomous driving, of course, is a booming market right now. So I see Flare making a lot of revenue. They were down 50% during the pandemic. They've already bounced back from that. And this one, on average, has been growing about 16% a year. So a nice little growth play. Also pays a dividend of 1.55%. Decent PE ratio, $7 billion market cap. And they raised nearly 19% of takeover, by Teledyne as well. And Teledyne, they just recently they unveiled a deal for Flare Systems, and basically, it's good analytic ratings too. Flare System also is going to provide products for the military, and that's such a thing. Analyst ratings got a 60% buy from 10 analysts. Great EPS Q2, Q3 of 2020. So yeah, take a look at Flare. Great business model, great fundamentals. Then we have a nice play here. This is a great play. PNW, Pinnacle West. This is something I already own. I am currently down on it, 4.65%. But that's just due to have been beaten down. It was 30% during the pandemic. Still has about 11% upside left in this stock. This is a dividend payer stock, almost 4%, 3.97%. Great low PE ratio of 14, so it's super undervalued. 14 analysts got it at 43% buy, 50% hold. And this company operates in Arizona, and their population growth, has historically been higher than the U.S. average. The driving rate, base growth, and investments in generation, transmission, and distribution. So, I have a high level of confidence, in the management team here at Pinnacle West, and I'm pretty much, going to set a target about 9.5% ROE or higher. Their earnings and their dividend growth are, going to be great in the future. And their annual dividend usually increases about 5%, So in 2021 to 2024, I see that 5% increase in that dividend rating. And this is a utility company out of Arizona. I got it confused with the last utility company. But basically Arizona, they have a higher population than, the average U.S. place or city. So with all those people needing electricity, that's going to be a great, avenue for revenue, basically. They've been killing EPS all 2020 as well. And like I said, they do energy, and they also make energy-related products as well. It also offers regulated retail and wholesale electricity to businesses and such things of that nature. So they have businesses, retail to the regular consumer, great dividend payer, great potential. And this Pinnacle West basically dominates out there in Arizona. It's not much competition, so they're going to make some revenue. They're going to make a bounce back. 2020, and they're going to make that growth revenue. Next, we have Aflac, ticker AFL. This is also a play I'm already in. I'm down 4.71% in Aflac. This is a pretty good dividend company. I'm pretty much down because it was down during the pandemic, about 50%. Aflac still has about a 17-18% growth left in it for 2021. And Aflac does insurance, if you don't know. They also pay a dividend of a little over 2.5%. Super low EP ratio. So very undervalued. 11 analyst ratings, 64% hold. They've been killing EPS all 2020 as well. And this is a company out of Georgia. And of course it does insurance in the United States, Japan. They have like life insurance, death benefits, and stuff like that. I'm sure you heard of Aflac. You've seen the duck on the commercials and things of that nature. Then the last thing here I got for you guys is my 3 best stocks to buy in January. The first one we'll look at is Teladoc Health. I'm bullish on this company. I'm up about 1% of my position that I have on Teladoc. Teladoc didn't get phased by the pandemic at all. It was up 141% on the year. Last 5 years, this thing's up over 1,000%. So divided by 5, that's like 200% a year of growth, which is great. Of course, analytic ratings, 29 analytic ratings, 62% bullish. And Teladoc is one of the most mature competitors in the telehealthcare sector, leveraging its national scale and nimbleness to take advantage of the blind spot between cost-conscious payers and sluggish providers. Teladoc's user base and revenue have grown rapidly and is expected to do so over the next several years through multiple channels. This company's reverse platform effectively matches patients with providers to avoid costly visits and assets to employers, and pays with analytics to analyze cost benefits. Teladoc had a great quarter 3. Quarter 4 is kind of looking shaky. We'll see how it goes. I've been in this one since September as well. And basically what they do is they have a platform like a mobile app for healthcare. They do video calls and things of that such. So basically if you're sick, you can get on the Teladoc app and you can talk to a doctor directly that can prescribe you what you need. You can go pick it up or have it shipped to you, and you're going to save money on office visits and all sorts of stuff, And now they got technology where you can plug into like these devices into your Apple phone and, diagnose yourself, scan yourself. If your wife's pregnant, you can do whatever it's called where you rub the stomach to see the baby or whatever it's called. I can't even think of what that's called. They're talking about being able to do CT scans, all kinds of stuff, man. So, if you got that thing plugged into your phone, you can diagnose yourself, talk to your doctor on the phone. He can see what's wrong with you with this technology as well. And then y'all can come up with a solution and a conclusion. And you can get your medicine right there, or you can say, hey, you're going to need surgery, blah, blah, blah. You need to do this and that. So it cuts out the middleman, cuts out the office visit. Of course, this thing did very well during the pandemic with everybody being locked down. They can help people with like flu, respiratory infections, chronic illness and pains like cancer and heart failure. So definitely a dope fundamental company here in Teladoc. Next here we got BAND, Band. This is Bandwidth. This company here, during the pandemic it was only down about 12%, and it still finished the year up above 145. This was a newer IPO as well. It's about 3 years old. It came out in November of 2017, and it's grown about 12% a year. So nice little growth play here. Doesn't pay a dividend. Non-analyst ratings, 89% buy. They've been killing EPS. And this is a telecom software company out of North Carolina. And it does cloud-based communication services. It offers data for internet, voice over internet protocol, messaging, managed network, and conferencing services. And it targets basically small and medium businesses. So yeah, cloud-based communication services is a great sector to be in at the moment, and will continue to grow. So definitely like this play. I like the steady growth in it, and I like the business model as well. And the last one we have for tonight is ticker AAXN. This will be a new swing trade for me. This one here was down about 30% during the pandemic. Still finished up the year above 60%. Well, nearly 60%. This thing typically grows about 11% a year, so it's going to be a nice little growth stock. 13 analyst ratings, 62% buy. EPS has been great. They did miss quarter 2 of 2020, but they bounced right back in quarter 3, and quarter 4 of 19 and quarter 1 of 20, they were doing great as well. This is give you exposure to the industrial sectors of the market. This is a company based out of Arizona, and they basically engage in the development, manufacturing, and sale of conducted electrical weapons for personal defense. It does like tasers, softwares and sensors and things like that. So it has all kinds of crazy tasers, accessories, and other types of related products and services. The softwares and sensors, you know, they have like wearable things. They do applications, cloud and mobile products. So a nice little defense play here. You know, I thought it was kind of cool. Thought I would look at it. I think it's gonna do well in January, now that everything's opening back up, especially after seeing, you know, all these riots and crazy stuff, political stuff going on with the unjustification stuff and the racism, and you know, and then, you know, them trying to take guns away and all this stuff. I mean, hey, get you a laser. I mean, a laser. Get you a taser. You know, that's an easy self-defense weapon. I mean, I would recommend you to carry, you know, get you a CHL, but, you know, if you can't have one, or if you ain't got one, or, I mean, even keep a taser too, you know what I mean? So, you know, besides taser, they do accessories and all kinds of other defense weapons using their technology. So, definitely something interesting and something I'm going to jump into. If you liked tonight's video, hit the like button, hit the bell, subscribe, all that good stuff. I would really appreciate it if you did so. I'm gonna go ahead and purchase about 21 stocks or so, and I'll drop that video, you know, just a little bit later. See you in the next one.